Government and Federal Reserve response to the early signs of crisis. Wall Street, in response to the spreading crisis, began to seek Federal Reserve intervention, advocating for preemptive action to counter the market downturn. Despite the Fed's caution due to the already low interest rate environment and the risk of further inflating asset prices, market expectations for a rate cut were high, evidenced by the Fed Watch tool indicating a 100% probability of a rate cut by late February. Amid this, Federal Reserve Chairman Jerome Powell issued an emergency statement on February 28, acknowledging the risks posed by the coronavirus and the Fed's readiness to act. However, the Federal Reserve's capacity to mitigate the crisis was limited, prompting calls for a more robust fiscal response. The Trump administration's initial $8.3 billion Corona Response Act focused on medical policy, but its limited scope did not fully address the broader economic impacts, leading to increased market pressure for a Fed rate cut. Effective fiscal policy, targeting specific sectors and needs, became crucial in complementing the central bank's monetary policy. However, the restrained fiscal approach from February to March, along with speculation about Federal Reserve actions, was insufficient in stabilizing the market as the pandemic's severity continued to escalate. The big cut. On March 3, the Federal Reserve made an unexpected announcement, significantly cutting the target interest rate by 0.5 percentage points from 1.50 to 1.75% to 1.00 to 1.25% ahead of the scheduled March 17 FOMC meeting. This substantial reduction, known as the Big Cut, was aimed at mitigating the economic threats posed by the escalating COVID-19 crisis. This move, however, signaled the limited scope for further rate reductions. The market's reaction was mixed. While some investors might view such aggressive monetary policy as a positive step to stabilize the market, others saw it as a sign of deeper, possibly undisclosed troubles, leading to increased anxiety and a shift towards safer assets. Indeed, the U.S. stock market experienced a temporary rebound but ultimately closed 3% lower. This response underscored the market's perception of the severity of the crisis, with many drawing parallels to the 2008 financial crisis and shifting away from riskier investments. During his press conference, Federal Reserve Chairman Jerome Powell underscored the limitations of monetary policy in the face of such a crisis and hinted at the need for robust fiscal measures, further amplifying market uncertainties about the future economic landscape. Powell's comments emphasized that lower interest rates alone couldn't remedy the sharp economic decline caused by the pandemic and that more comprehensive solutions were necessary.